Hey everyone, let's dive right into this explainer and connect the dots between massive geopolitical shockwaves, national economic policies, and the rapidly shifting trillion-dollar tech landscape. We are looking at a deeply intertwined global system right now, and to truly grasp what's happening in June of 2026, we have to look at how these massive macro events are trickling all the way down to corporate investments.
Now you might be wondering, how on earth does a closed international waterway, a brand new Federal Reserve chair, and the construction of a new AI data center actually connect? It sounds like the setup to a weird joke, right? But as we'll see today, they actually trigger a fascinating domino effect that is reshaping the global economy right before our eyes. Everything is linked, and pulling on just one thread unravels changes across the entire globe.
To figure this out, we're going to take a macro to micro approach today. Here is our agenda. 1. The US-Iran peace deal. 2. Unlocking global oil markets. 3. The Fed and the dollar. 4. Tech's trillion-dollar moves. And finally, number 5, the Reliance blockbuster. Let's get into it.
All right, Section 1, the US-Iran peace deal. So let's start with the absolute biggest domino that just fell, the draft Memorandum of Understanding negotiated between the United States and Iran, which was notably brokered by Pakistan. What's absolutely fascinating here is the stark contrast. On one hand, we've got immediate relief, reopening the Strait of Hormuz for commercial shipping and ending direct military operations. Great, right? But then you look at the unresolved issues slated for a 60-day intensive negotiation period. We are talking thorny stuff. The exact length of a pause on nuclear enrichment, where the US reportedly wants 20 years and Iran wants 10, plus handling proxy groups in regions like Lebanon, and the tricky timeline for unfreezing $24 billion in Iranian assets.
And look, while that immediate ceasefire is a huge sigh of relief for global markets, experts are urging everyone to hold their horses. Stephen Cook, over at the Council on Foreign Relations, hit the nail on the head. He noted negotiations on the outstanding issues, especially on Iran's nuclear program, will be long and difficult. Verifying dismantled nuclear sites and dealing with those complex proxy conflicts, it means the whole situation is basically walking on eggshells. The pause is great, but the heavy lifting diplomatic work is literally just starting.
Moving right along to Section 2, unlocking global oil markets. Because when the Strait of Hormuz is involved, the world's energy supply is watching like a hawk. And the immediate reaction? Wow. Optimism around this peace deal sent Brent crude tumbling below $80 a barrel, landing right at $79.96. That is a massive psychological and economic threshold, guys. It marks the very first time prices have dipped this low since the conflict really blew up back in early March. Just the mere anticipation of the strait reopening was enough to send a massive recalibration through the market.
To really wrap our heads around how severe this blockade actually was, check out this data from the Energy Information Administration. A mind-blowing 11.3 million barrels per day were shut in, completely halted. Because of that insane bottleneck, global OECD reserve inventories got drained down to 2.3 billion barrels. We haven't seen levels that low since 2003. At that burn rate, the world was looking at a measly 50 days of future supply remaining. I mean, talk about running on fumes. That is an incredibly tight margin for the entire global economy to operate on.
But now, look at this projected relief timeline. Back in May, the EIA tracked Brent crude averaging $107 a barrel. But as the strait slowly reopens, they project a really nice glide path, easing down to $105 for June and July, dropping to $89 by the fourth quarter of 2026, and eventually stabilizing right around $79 in 2027 as all that halted production comes fully back to normal. It's a slow, steady path back to sanity.
All right, on to Section 3, the Fed and the dollar.
So while the diplomats are negotiating and the oil markets are resetting, central banks are doing their own very complicated math. Remember, energy prices directly impact inflation, and inflation is the Fed's ultimate boss. Right now, U.S. inflation is stubbornly sitting at 4.2%. Because of that, markets are pricing in a 97% probability, basically a lock, that the Fed holds interest rates steady at 3.50 to 3.75%. So, since the rate decision is a foregone conclusion, the real drama for the global financial system is the highly anticipated debut of the new Fed chair, Kevin Warsh. Investors are completely desperate to hear how he frames the trade-off between sticky inflation and a shifting labor market.
Instead of the current rate, all eyes are actually on the dot plot, the Fed's visual projection of where future interest rates are headed. Earlier this year, the dot plot was basically teasing a rate cut by the end of 2026. But now, With inflation stuck above 4%, everyone is watching to see if policymakers erase those projected cuts, push them to 2027, or, dare I say, even signal a potential rate hike. It's a massive waiting game.
And amidst all this, we are seeing a structural shift that literally breaks traditional financial rules. Historically, a strong US dollar means weaker gold prices, right? Because gold is priced in dollars. But the 2026 reality is totally upside down. We've got a relatively strong dollar, yet gold is absolutely surging toward an unprecedented $5,000 per ounce. How is that even possible? Well, geopolitics and central banks aggressively diversifying their national reserves have created this unique, wild environment where both the dollar and gold are acting as parallel safe havens at the exact same time. It is a complete new paradigm.
Which brings us to Section 4, Tax Trillion-Dollar Moves.
Let's zoom into the micro level now and see how corporate giants are maneuvering their massive piles of capital within this crazy macroeconomic environment. We just witnessed a historic market shakeup. Following an explosive IPO, SpaceX has officially overtaken Amazon in market capitalization. Yeah, you heard that right. SpaceX is now valued at a staggering $2.7 trillion, just edging out Amazon's $2.65 trillion. It's an incredible milestone that perfectly highlights exactly where investor appetite is currently focused.
And guess what? The catalyst for this valuation surge wasn't just rockets, it's artificial intelligence. SpaceX just announced a bold $60 billion stock acquisition of the AI coding startup Cursor. They are fully integrating this with their XAI Grok chatbot and massively ramping up their computing capacity for AI models. It's sending a loud, clear signal. SpaceX doesn't just intend to dominate the physical frontier of space. They are coming for the digital frontier of AI automated coding too.
And finally, Section 5, the Reliance blockbuster.
To really bring this home, let's look at another corporate titan leaning heavily into AI and digital infrastructure, India's Reliance Industries. They perfectly illustrate how global energy giants are navigating this transition. Reliance just reported an absolute blockbuster quarter. We're talking a 78% jump in profit to nearly 27,000 crore. While their roots are in traditional oil to chemicals and oil and gas, their growth right now is exploding through their digital arm, Jio Platforms, which just crossed 200 million 5G users, and their incredible retail expansion. They are basically taking cash flow from traditional energy to fund a massive digital empire.
And all of this digital momentum leads directly into their newest venture. Reliance just partnered with Meta to build a colossal 168-megawatt hyperscale data center in Gujarat. The synergy here is unreal. Step 1, the partnership forms. Step 2, Reliance completely manages the construction, incredibly powering the whole thing with 100% renewable energy and using desalinated seawater for cooling. Step 3, Meta swoops in and leases the entire facility to power its global AI compute needs. It is the ultimate marriage of hard infrastructure execution and next-gen digital demand.
Chairman Mukesh Ambani summed it up perfectly. He recently stated that the business is on track to double every 4 to 5 years. Think about that for a second. When a conglomerate of this sheer size expects to double that fast, it tells you everything you need to know about the velocity of the modern economy. We are watching traditional energy giants go all in on digital infrastructure, AI, and green tech. They are completely reshaping their identities in the process.
And that brings us to our conclusion. Wow, okay, let's take a quick breath. We've traveled a long way in this explainer today. From a super fragile geopolitical breakthrough in the Middle East, right through the data-driven halls of the Federal Reserve, and straight into the boardrooms of trillion-dollar tech valuations and the sustainable AI data centers of tomorrow. The big reality here? None of these events happen in a vacuum. A reopened strait lowers energy costs, which might cool inflation, which shifts the Fed's math, which then impacts the cost of capital for giants like SpaceX and Reliance to actually build our AI-driven future. It's like one giant global puzzle. Understanding how these pieces connect is your ultimate tool for navigating what comes next. So I'll leave you with this. With all these massive intersecting forces, what domino do you think is going to fall next? Keep that in mind as we watch the second half of 2026 play out. Thanks so much for learning with me today.